Live streaming is on.
All right, Event Trader here, and I'm about to be joined by chart trader none other than Brett Manning, of course. Brett, how are you doing today?
I'm doing great, Gav. How are you?
I can't complain, can't complain. We're just going to take a quick look at the markets here as we can see relatively choppy action, Brett. I think that nothing really shouted chop more than you and Scott coming out right at the same time, one with a short, one with a long, and
Yeah, I noticed
NASDAQ.
that, right?
When I saw that, I was like, yeah, pretty much sums up the market for what we're expecting today. Of course, we got Fed Chair Jerome Powell tomorrow, and just watching this action play out. Before we break into the sentiment and flow show, Brett, anything you would like to mention with the market that you're seeing today and the tape over the last couple of sessions?
No, I mean it's what you'd expect. I think in a lot of ways in terms of late August, the second half of August is either amazing or terrible from the standpoint of somebody who trades from a top-down kind of perspective and like correlation in a thick, active, emotional market. It's usually either really something breaks. It's kind of like it's kind of like an options expiration day, a big monthly options expiration, or where you
Or
get
jobs
this.
day or something.
Well, but really, I think with OpEx, it's kind of like there's a bunch of options market makers trying to pin certain big strikes, and sometimes something comes along and shakes things loose enough that it gets away from them, and you get a really volatile options expiration. Otherwise, options expirations are usually really contained, so there's sort of they're sort of one fat tail or the other. They're sort of really awful and tight and choppy, and probably three out of every four are that way. And then one out of every four, something breaks loose and it becomes really volatile. Um, I would say the second half of August is similar to me. You get a lot of the main decision makers off the desk, and things are thin, and the action gets tighter, and that causes the small number of market participants who are actively involved to increase their leverage. But without a lot of backup, when you go up the ladder and down the ladder outside of the inside market, so the algorithms are doing less, and you get this sort of like no safety net on either side of the tape, and people who maybe aren't as experienced trading with more leverage because they need to make a large amount of money on a small move because there's nothing but small moves. And then it breaks outside of that range and something happens and you get a really dramatic move. And we've seen over the last 10 years, probably two or three kind of crashes in August. And those are amazing periods to trade for the process that I generally use. And otherwise it's just awful. And so this has been the awful version, and I've been staying mostly away. I mean, today was an interesting, different kind of opportunity because it was a geopolitical catalyst and a big one, and obviously a tragic one. But
Right.
but very rarely is that going to actually change a market trend. Generally speaking, it's you, especially given the scenario I just suggested. You got a thin tape, you got people who are leveraged up too much. You start to run those stops outside of the last 2 day range. You're going to get something that looks like a dramatic reaction. It's spurred by the headlines, but it's not going to change the trend in the market. So I was just looking basically for an opportunity to wait until I felt like the right level of stops had been shaken and then to start buying.
Yeah, and we'll talk a little bit about the leverage and the risk and sentiment coming up right now. So, how about we break into this sentiment and flow show here and take a look at some of the data points that we've been seeing. Obviously, Brett, the first thing we probably want to address is Jackson Hole, which kicks off this week. That's our first slide. Brett's put together a nice little breakdown there, as you can see, of the Doves and the Hawks. Now, of course, we had some comments today from two of the Hawks, Mr. Bullard and Ms. George, here talking about them seeing a need for a rate or for a tapering anyway. We haven't seen the rate hikes discussions at all yet, but certainly a pullback of the punch bowl. So, Brett, I know you've been talking a lot about the idea that when you see a hawk talking hawk, it's usually not that big of a deal. And same thing when you see a dove talking dovish, that's
Mm-hmm.
not really going to have a big impact on the markets. But as we take a look at this list here, who do you think are the key swing votes here?
I mean, it really, you'd think that's about like who's going to flip from one list to the other, but I don't think it is. I think it's about the edges. So Kaplan's been maybe about the most hawkish. Him or Bullard, if they were to say, we saw this the other day. So Friday, I think the whole market was taken back higher, in part because Kaplan came out and said, Delta was something that might cause him to change his view.
Right.
And you saw the impact of that. So if you want to talk about what's going to make the biggest difference in terms of how the market sees things, then you're talking about either edge coming forward. So if Kashkari or Evans were to start to say, you know what, inflation's starting to worry me, it would be a
Huge.
revolutionary change in the market.
Right.
Yeah, because you'd know everything else would change too. Like, that's the point. When the edges change their tune, it implies the whole center of gravity of the Fed has changed. And they're going to have full support. They're going to have full support for mobilizing a whole different set of strategies. And the fundamental backdrop of monetary policy is shifting. And if you see, Kaplan say something hawkish, it doesn't imply any change. So that's his job. That's what he's going to keep doing. He's got a message, but he doesn't have enough votes, even in spirit. So I think that you got to see the edges out there before, if something shifts there in the messaging from the edges, and probably that's something they discuss behind closed doors. I'm going to say this. I don't think that, some of them, Bullard seems like he shoots from the hip a bit, but some of them probably, would let, like, if Kashkari or Evans were going to change what they were saying, they probably would make sure that Powell knew about it in advance.
You think Kashkari would? I find him to kind of be.
He does seem a little bit, he knows the impact it would have.
Guys,
He's smart though. He knows markets. He wouldn't want to just become a black sheep. Like, I think you're rocking the boat so bad, then you've got to, like, at least talk it over and to say, here's my concerns, and I'm willing to go public with this. I imagine there's a lot of conversations like that, because these guys are messaging. When they message, it's the tip of the iceberg, and there's a much bigger iceberg underneath the water, I think, going on in private conversations about where the views are.
Right. And the 23 and 22, I assume these are where you assume they are on the dot plots, meaning the magnificent.
Yeah, I think we know at this point these are the dots. Right. These are the dots.
This is a pretty helpful piece to have at the ready. Now, obviously, we got Jackson Hole tomorrow, Brett. There's certainly, for the longest time, there is a lot of expectations about Powell starting to hint towards the tapering by the end of the year, and we'll get into some of the market expectations on when they expect tapering here shortly. But that has really been reined in, and a lot of people are talking about Powell getting a little bit more opaque in his outlook here, and just being very vague as he's been the last couple of periods. What are your expectations for Powell, and do you think that this will be a big event for the markets at all?
I think that if Jackson Hole were happening a week from now, it might be different. But I think that it's too close up against what we were seeing in terms of escalating expectations for the Delta variant to have an impact. And we even started to see credit spreads widen a little bit. And we started to see, I think copper was down like 19% from its highs. And there was a lot of little market indications of markets across the broad asset spectrum starting to discount the possibility of an economic rollover and possibly even like a flash recession in the fall. And that would be presumably driven by people starting to tighten up around the idea that we're having this new wave with Delta. I really have never bought into that would manifest, unless, I guess, it's just jarred into people enough. But it seems like it just hasn't changed economic activity very much at all, because the caseloads are picking up, but the hospitalizations and deaths really aren't in any way that's too easily correlated. But it looks like a lot of that data is showing some signs of possibly bending right now, and I think the markets are reacting to that. You look at like the sort of 7-day average caseload is starting to roll over. The positivity rate per every such and such number of tests is starting to decline, and those are readings that have been consistent with what we saw in the UK, what we saw in India, what we saw recently in China, where it looks like Delta seems to roll over sharply when it rolls over.
Right.
And the markets, I think, are really starting to price that in, the idea. And they could be wrong. This is noisy data. The IHMA recently came up with a projection saying that by sometime in late September, we'd see a 40% decline in Delta cases in the U.S. So I think all those data points, but those are really just the last couple days. And I'm not sure if that's enough ahead of Jackson Hole for it to change the Fed's strategy at Jackson Hole. So I think if they had more time and we saw more confirmation of this, we might see a more hawkish Jackson Hole. But I think given how tight it is and how speculative some of this data is, I think the Fed is going to be acting on the world as it was a week and a half ago, which is, starting to see some of these widening spreads and starting to see some of these signs of potential risk to the economic projections, which would mean Powell's going to always play it safe on that, especially at this point. He's got PTSD around this, just like most people do. So I think that really we've pushed out that hawkish moment.
All right. Any trading opportunities you see for tomorrow? Would there be anything that would be in an ideal setup for you?
I mean, I think the view that I just expressed has been mostly what the markets now believe anyways. So
Right.
trading opportunities around a Fed event like this would really be if something counterintuitive happens.
Right.
And
Like
I
all of
guess
a
there's
sudden he
some
comes
percent.
out with something hawkish.
Yeah, that would certainly be, buy the dollar, sell the risk assets. And I mean, and I think it'd be a policy error kind of bet that comes in, which means you're probably going to see rates go down. And, people start to look for like, well, this is the Fed is off base and we're going to see, economic slowdown, and you're going to see the yield curve flatten, financials get killed. So, but I don't see that. I guess, if you're looking for what the opportunity would be in an if then kind of scenario, if he comes out and basically says, something that feels like one of those 22 dots talking, then yeah, you're going to see a lot of interesting movement. But otherwise, I'm not sure will be anything more than a
Non-event.
non-event.
Okay, let's move along then to the sentiment data here, Brett. We got the AAII data fresh off the presses, and it's definitely been a lot of fluctuations the last couple of weeks here. We went from 37 on the bullish side back to 33% bullish, with the majority of them flipping from bulls to bears, and now we got it flipping back really with
Can
a
I
bullish.
pause you just 1 second? I
Yeah,
see a couple of feedbacks of people they can't see the slides.
they can't see the slides, huh?
Do we want to just maybe?
Hold on a sec. Yeah. Let's see.
Can you guys see the slides?
If you can hear us, refresh your browser. Try doing that. I'm seeing the
If you can't
slides
see the
showing up.
slides,
Are you seeing the slides up, Brett?
I don't have it open. It'd be tough for me to.
Yeah. It's I see it playing here, so it should be. It's certainly taping it. So if
No
you're only
slides
here,
showing. All I see is Jim's charts. I don't know, because that would be a significant lack of
yeah,
value given how we prepared this today.
yeah. Let's see. I mean, I'm seeing the slides popping up here. Try refreshing your browser and let us know if that's helping with the slides.
Yeah,
Right,
I
somebody's
can
screen.
see. Oh, no, I see the chart. I just opened it right now.
And you see Jim's chart.
Yeah.
All right, let's try this.
Trying on a brand new browser as well. Oh, you know what? That's it. So, guys, refresh your browsers. I just opened it on a different computer that wasn't open to briefing.com. So I think you got to just shut your browser down, actually, which I know is a pain, or unless you got a backup browser like a Mozilla or Edge or something.
Yeah, I've seen people still.
But you can definitely see the slides with a brand new browser.
Yeah, I'm definitely seeing them here. This will be taped, so you should be able to get it.
And you can see it there.
Okay. So anyway, let's get back to the AAII discussion here, Brett. So as you can see, a lot of fluctuations in that data point, jumping with the bulls going from 37 to 33, then popping back up to 39 with this morning's reading. A lot of that were people moving off the neutral area into bullish territory. Certainly a little bit of a digression from a little bit of a slide from the bears to 35 to 33. Now, with that, Brett, you had put together this bullish ratio, which I know you prefer using as your primary read. So, what's the data telling you here?
Well, I think that you've just seen, this is about where, a sample of people believe the market is likely to go up or down over the next 6 months, or neutral, and this takes away the neutrals and just looks at people who have a directional opinion, and it's dead in the middle of the range. So we've seen since January 3 major periods of extreme bullish opinions, a consensus believing the market was going to go higher. And this is usually a lagging contrarian indicator. So when it festers in an area of a consensus, then it oftentimes spells the possibility of a problem, but sometimes it doesn't. And this is starting to look like one of those times. Maybe it didn't, because we're starting to see those views change in over a sustained period of a month or two. And I think, again, a lot of this is maybe sort of as we reared up. You could look at this a little bit like, an inverse to the 10-year, like this moving down, the 10-year rate moving down with it. Just kind of expectations of growth and the possibility for Delta to become a big factor. And you see a big slowdown, and maybe the Fed has to tighten because of inflation, and all these sort of ideas coming together. People have just become less bullish, at least by this reading. So this is one reading, but I think that it's kind of mirrored a bit across a lot of things that don't contain a lot of options data. And again, options have been kind of poisoned by a new class of market participants that uses options almost exclusively. So if we exclude the options data, this is relatively representative. And I think, again, interest rates offers another example. Like, you're seeing a little bit of a shift in terms of attitudes around the market. And since this is a contrarian indicator, this makes it tougher for somebody to take, I think, a sentiment-based short position right now. But there's a debate around that in my mind, which is it may have festered into a bullish extreme for a long enough period that you have views changing, but you still may have overexposure. And that's a question I haven't really answered for myself. However, if you want to go to the next slide, the hedging data is starting to move to where you're starting to see close to mid-range on the equity hedging index, which it's awfully tough for a market to go into a serious correction when people come into it already with some decent hedging profile. So this suggests that people have become relatively hedged, or at least quite a bit more than we were seeing maybe a month or two ago.
Yeah, there was a interesting report today, Brett, in the Financial Times, where some FINRA data, the Financial Industry Regulatory Authority, showed that investors had borrowed $844 billion against their portfolios in July. This is down from a record number of $882 billion in June, and also marked the lowest level since March. So with this equity hedging index and that FINRA data, you're certainly seeing signs of some of the over leveraged aspects of the market at least starting to come out, and we'll continue to see
Right,
that
exactly. Without a correction, which is
without a
interesting.
correction.
Yeah,
Right. So yeah, that's definitely something that's going to bear watching, because that on the surface would be same as the AAII bullish
yeah.
for the longer term of the markets, because when you're seeing this and you're not seeing the markets going down,
Yeah.
that definitely starts raising a little bit of, I don't want to call it a red flag, because it would be a positive for overall
Well, red
equities.
flag for bears. I mean, it's
Red
like
flag for bears,
if
sure.
you're sitting there, right, just consistently adding to a short position in this market as it goes higher right now. Yeah, I mean, there's a lot of arguments you make on a secular basis that that once the damage happens, it's going to be quick and sharp. And there's an opportunity for a change in the tone of the market, but it's just I wouldn't feel comfortable if I'd just been gradually accumulating a large short position, given the fact that, yeah, we've seen kind of a stealth correction.
Yeah.
That didn't really manifest itself in a big downside impression. Usually that is typically something that makes it painful if you've been scaling in short.
Yeah, exactly. So moving along here, Brett, let's jump right into then the Bank of America fund manager survey information here. These are some of the bullet points that we're going to be discussing. Was there anything in particular on these bullet points that was jumping out to you, Brett? I know we'll be getting into a little deeper on each one coming up here.
No, I mean, I think that just the sort of the general theme that we've had this, and I think it matches up just with what we were just saying. Like there seems to be, and you can see for the Bank of America, that they have the sort of meter, and it's moved back to an area where it was very near their kind of sell signal as of a couple months ago, and it's moved back way off of that during this same period. So there's this kind of stealth correction idea, and I think a lot of it does have to do with the gradual rise of the significance in terms of media representation and policymakers' representation of Delta. And if that turns out to be something that's starting to roll over right now, maybe, then I think that that plays into everything. But this suggests a lot of beginning to rumble to the surface sense that things may not be headed into some kind of economic or market nirvana. We're starting to see a little bit of bearishness creep into the Bank of America Fund Manager survey. But again,
Right.
this is really from the middle of last week.
Or at least a further pullback on the peak bullish sentiment, right? So
Yeah. But again, this is like a week and a half old in terms of
right.
where the readings were collected.
Right. It's through August 21st is when this survey was put out. But let's take a look at some
Was
of these.
it?
Yeah, that's.
No, it's the 17th.
I kept seeing the number August 21st coming up. So I could pop back and check that, but that's what I was seeing. So,
Okay.
well, let's take a look. First
August
slide up.
17th. I'm looking at it right
August
now.
17th. Okay.
August 17th.
Okay.
And so the data is collected over the course of, let's say, a week ahead of that, and then it's published on August 17th.
Okay.
So think about the views expressing, let's say, a median world of August 12th, 13th, 14th.
Right. Okay. So, taking a look then at the data, we got macro expectations, the lowest since April 2020. Obviously, Brett, there was some easy comps going on in April 2020 as we were just coming out of that March period, and people were starting to look at perhaps a rebound in the overall markets. The markets had already started to climb back higher, and the expectations for March had dropped off so low that it was pretty easy for April to see a little bit of an uptick. But now we are back at those levels there, which certainly again suggests that bullish sentiment that's out there is starting to wane a little bit, at least on the sentiment side, perhaps not in fund flows. So anything from these macro expectations that was jumping off the page to you?
Yeah, I mean, so I think it kind of follows on what we were saying, but maybe it gives a better framework to think in these terms. If this is for a median world of let's say, you could even make the case that a lot of these opinions were representative of $600 billion worth of fund manager holdings of 2 weeks ago. And then we got that stab down, we got that gap down, then we got Kaplan coming out, and we got some of this data rolling over for Delta, and the market has ripped back higher. And it suggests a beach ball kind of situation, right? The beach ball in the swimming pool. If people were already starting to see their views roll over, they were more hedged. We see that in the hedging data. People were starting to get to the point where they're like, a month or two from now, we could really start to see, again, this kind of idea of maybe even a flash recession. And I need a position for that. And some of that was already in the market, and you get this stab down. We've seen a market over the last few days that looks like it's been squeezing people. And that, I think a lot of this data is going to show a sense of why there were vulnerable shorts to squeeze.
Right. So moving along, profit concerns, Brett. These have fallen drastically since March. As you can see, you hit that peak in March 21. Obviously, a lot of this is going to be tougher year over year comps, but you got to figure too, inflation concerns are starting to hit on the peripherals for margins. Wouldn't you agree?
Absolutely. It's turning out to be more durable. And that's going to be another big theme that continues.
Yeah, and we'll see that playing out here in one of the slides coming up. But this is something that we'll continue to watch. And from my perspective, what this does is that valuation, which I know we really haven't traded off valuation concerns in about 2-3 years, I suppose. But it is going to be something that you're going to see argued a lot more vehemently if these margins start going down.
Yeah, so I would say valuation is something that never puts a top in the market, but it does impact the depth of a correction when a correction happens for other reasons.
Right.
Where's
Exactly.
somebody going to step in and dig their heels in and say, I don't care what the world looks like right now, this is cheap? That gets a lot lower if you're coming from a very overvalued place.
Exactly. So, I mean, and that's what we're looking at here, and you can see big drop down. I think it's the lowest since July of 2020. So again, starting to see more and more numbers along these ways, at least on the sentiment side of things. Certainly haven't seen that played out in the Q2 earnings as of yet. Okay, moving along. First time investors say margins will decrease since July 20th, just kind of building off of that profit concern.
Yeah, no, I am just seeing, by the way, the Pentagon says that a number of U.S. service members were killed in the Kabul attack.
Okay.
And I
Right.
think that before this, we had the idea that maybe there was just a couple serious injuries. So
Yeah, one has to wonder if that was an attack on U.S. soldiers or if that was an attack on just the airport where U.S. soldiers happen to be. So that'll be definitely something that the Biden administration is going to have to come back and I would think have some sort of answer for, right?
right, and I'm noticing the market rolling over the last 9 or 10 minutes, and it looks like that's when that report came out.
Okay, so we'll keep an eye out on that. So again, Brett, back to this margin talk here. Will decrease since July. First time that they thought margins would decrease since July 20th. Again, just building off that inflation concern.
Okay, sorry. Which I was absorbing that. Oh, inflation concerns have rolled over. Give me the title.
Yeah, with the margins, very similar
Okay,
to the
yeah, sure.
inflation concerns topping out. Investors say margins will decrease since for the first time since July 20th.
Yeah, I mean, I don't know how to interpret that other than that it's another similar point. I mean, a sense that there's been sort of a mini cycle. If people are looking for a flash recession in the fall, and again, this is the world of 2 weeks ago, and you're thinking this, you just extrapolate the Delta data, which now seems like a different extrapolation, but in the world of 2 weeks ago, that extrapolation looked like here's another serious wave. It's going to start impacting behavior. It makes sense to me that this would be the first point where you'd start to see, margins decreasing up, and of course, the prices of the goods are supply chain constrained, so it's not really a fair demand driven set of relationships, so you're going to see a squeeze.
Yeah. Yeah, I'll be curious to see if we start seeing signals of this switching in Q3. That's for certain. Had Taiwan's government come out and say that they thought the supply chain shortage for the auto chips would end in Q4. So it's the first time we're starting to see some positive talks on that.
Really?
Yeah,
I didn't notice. I've
it-
seen the kind of the opposite news.
that was at the beginning of the week they came out with that comment saying
Okay,
Q4.
good.
First time that I've seen an actual date being put out. It's generally been for a number of quarters. So
That entire issue just is still so baffling to me that it just seems to completely sit outside of any notion of market forces.
the
I've never been able to, yeah, sure. This just the semiconductor shortage, just the idea that there's something that the price doesn't go up and the development of more resources and capacity. I mean, I understand that there's a long lead time, but there is for developing new oil wells too.
yeah.
It's strange to me that either we can't adjust faster, and I'm not saying we should be. I'm just baffled by it. We can't adjust faster, or we had the assumption that we could in the first place. To look at it like a shortage rather than just there is this number of chips available, we look at it like something's gone wrong in that market. You
Right.
understand what I'm saying? It's a
No, no,
strange framework.
yeah, it's the argument that I've been doing for the SMH and semis in general, where you continue to see them kind of go on this roller coaster ride, and I talk about that there's a long runway for demand out there. The key always
Sure.
is making sure that you can fill that runway before people decide to just kind of leave the market, right? That's always the concern when you meet a supply shortage like this, and that's where you all of a sudden get people ramping up capacity utilization.
But there's
And
never going to
then
be a
there's that
drop off in
demand not there.
demand. There's never going to be a drop off in demand at this
Never?
point. For chips, like the entire
Well,
world is going to be made of chips in 30 years. Like
not
your
not not
paint on your walls in your house will be chips. Like there's
I'm not arguing that, and that's why I continue to press
right.
home the semiconductors. But you could see things dry up if like prices are running too high, and people just would prefer to hold off on making that purchase on things. So
Yeah,
I
it's just
mean, because you always are going to have an end customer that's going to need to do it, be it used cars, be it vacuums, whatever it could be. So, and then if all of a sudden you have the companies that have supplied all these chips and that demand's not there anymore, then that's always the risk that you're going to run on a supply shortage.
right.
So it's gonna be a dynamic that would play out in the first part of next year. So that's going to be the one thing that I'll be looking at and now just kind of paying attention to in these conference calls when Q3 earnings start rolling out. But moving along here, Brett, inflation expectations have rolled over, but rate expectations are still rising.
Cognitive
Anything?
dissonance.
Yeah, exactly. So what's your takeaway from that slide?
I mean, yeah. So it's just it's cognitive dissonance. I mean, well, you could say so. You could say supply chain. This is, I suppose, optimistic on supply chain constraints. One could see it that way. And so, in other words, rate expectations were never really tethered to inflation expectations, strangely enough, because inflation expectations were related to a factor that couldn't have been controlled by monetary policy in the first place. I guess is one way to try to explain that cognitive dissonance, but I'm not sure that this chart is representative of something that's going to be a dynamic that's meaningful over a larger time frame.
Right. You just figure this is soft data that's kind of missing the point.
Well, yeah, I mean, there's been because inflation is being driven by forces that, just like we were just talking about, there's not a tremendous amount that the Fed can do about that source of inflation if it really is about kind of idiosyncratic supply chain situations. So, I mean, there's a case to be made that rate expectations and I guess it really depends here what time frame inflation expectations we're talking about. Is it what CPI is going to be next month, or is it 5 to 10 year inflation? And I don't think that's really explained in this chart.
Yeah, and then that'd be the holy grail, trying to figure out inflation, what it's going to do for the next 5 to 10 years. I don't
Well,
think
but I
anybody's
mean,
been able to
probably
answer that question, right?
I'm guessing rate expectations are tethered to long-term inflation expectations,
Sure. No, that's
right?
fair.
And so this
Yeah.
is probably a short-term measure of what's the Fed going to do next month versus what's CPI going to do next month, and that really I could see those ideas being divergent now much more so than in years past. And if you look at this chart, this is showing the last 20 years. So right now we have a different form of inflation, a different source of inflation, and a Fed that's trying to manage a larger time frame process. So only recently have we seen these two ideas start to diverge, and that makes sense to me.
Yeah. Yeah, and as you said, this is just a recent phenomenon, and obviously a lot of one-offs with monetary policy that makes this even a little bit more confusing. So, let's see. Next up, risk expectations have rolled over, but equity allocation still to follow. So basically, the idea being that people have reduced the risk, but the equity performance hasn't necessarily changed. And it kind of talks about what we've been hitting for a main point, Brett, right? There's a lot of bearish data that we're seeing, or perhaps not as peak bullish as we'd seen over the last couple of times we did this show. However, the markets still haven't gone anywhere to suggest that that's playing out in the overall allocation of funds.
People are still overweight equities, but they're starting to. I think this chart really shows just a shift in the risk profile of the equities they're overweight, in a sense. So they're overweight equities. They want to stay overweight equities, but they're moving to probably lower beta profile.
Right, and we'll see that play out here in a second when we take a look at how people are positioning. But 84% of the people, Brett, in this next chart that we're looking at, expect the Fed to taper by year end. It's a pretty high number. There's certainly it's, the commentary that we saw from Bullard and George would back this notion up. But here's some of the different expectations on where this tapering is expected to be announced. And as we can see, September FOMC has jumped over Jackson Hole, and that's been reflected in the commentary that we've seen over the past couple of days, right?
Yeah, in fact, I would say it's 100% of people who don't think there's going to be a recession in the fall. I think 16% of people must believe there's going to be a recession in the fall, because this is really asking people, when do you expect the Fed to begin signaling tapering will begin at some point, right? And by
Right.
year end, everybody who doesn't think there will be a massive explosion in Delta and a new recession would believe that. I think the most dovish perspective on the Fed is still going to be ready to at least signal to the market that there is such a thing as tapering by December 31st.
Right.
So I think most people thought it would
What's
happen at Jackson Hole in July, and that's shifted. The difference between
yeah.
Jackson Hole in July and Jackson Hole in August is the intensification of the Delta caseload.
Exactly. That's the obvious difference here. And you can see that kind of playing out where Q1 2022 wasn't even on the board for last month. And here we see it pop up to about 10%. So,
Right. Which is the credit spreads widening, copper being down 19%. And I think, again, all these things are like, if we just looked at that data on Delta like 8 to 9 days ago, it was just starting to turn into an exponential curve of caseload in the US. And I think that we got PTSD around this thing. We went through that last year. There's still some percentage of people who are just going to go, this is going to blow up into an infinite problem, because I've been through hell for the last year and a half. And it's tough to remain detached in your analysis, I think.
yeah. Okay, next up, fund managers survey shows investors expect roughly 1.7 trillion to be passed. This number was up from about 1.2 trillion
Mm-hmm.
last month when we were talking about this, and you can kind of see the rise in expectations where it went from 1.1 to 2 trillion is still the base case scenario, but there's been a big pickup of the 2 to 3 trillion. Certainly, and this is before the news that we were seeing this week with the House being able to push
Mm-hmm.
that 3.5 trillion package through. You could also see an uptick in the 3 to 4 trillion that was expected from July to August, and 4 to 5 trillion is now coming into play here in August when it wasn't even in the mindset in July. So with the inflation and growth expectations, are you kind of confused by seeing this chart here, Brett, compared to some of the pullback we've seen in growth expectations and inflation?
No, because I think I'm going to go out on a limb here and make a case that this is the same data point yet again that we've covered in the last 8 slides. That when you start to feel like, one, it's easier to make a case that the economy is still vulnerable. It's easier to make a case that it needs more fiscal stimulus. I think it's possible that it makes it easier to pass the bill. If people think we're headed into growth nirvana across the economy over the next year, starting right this second, and inflation is going to be hell, and that's our big demon, it's harder to pass a multi-trillion-dollar fiscal package. And if people start to think, well, we're headed into recession in October and November, and who knows, maybe COVID's going to go on forever, it gets easier and easier. There's going to be one variant after another, and we're never getting out of it. It gets easier and easier to pass a bigger package here. So I think,
Right.
then remember, we're asking fund managers who are looking at the credit spreads widening and copper down 19%, and et cetera, et cetera, et cetera, what they think. And what they think going up from 1 month to the next, where suddenly COVID looks like a bigger issue again in that second one, it's easier to believe that that could potentially, now it may be political factors that I'm not aware of, but it could potentially explain this change from July to August, just that it's easier to pass a bigger package when things look more vulnerable.
Yeah, and that's certainly been playing out in the press, and definitely in expectations here, as we can see. So that is on the rise. So any of those headlines we'll be paying close attention to. If we start seeing that 3.5 trillion package falter, we'll have to keep an eye out on the cyclical plays there for sure, given the sentiment read. Taking a look at the greatest risk to financial stability is emerging markets and monetary risk. No real surprise there, but the emerging markets, I think that primary concern is China, with a lot of the new regulatory rulings that we've seen from the government, as well as an uptick in COVID cases. Now, they did start slowing down a little bit this week, which again would have been after we started getting this data. So he's expecting to see perhaps some changes when we get the September read of this concern, Brett.
Rephrase that question.
So the emerging market risk, a lot of that has to do around China. However, we've seen a little bit of a recovery in the Chinese COVID numbers over the past couple of days. Now, the regulatory risk is still going to be there. Would you expect to see the concern about emerging market risk reduced come the September fund managers survey?
So I think it's possible that your assumption that a lot of that has to do with China might not be correct. I mean, I think it could. I could make the case that emerging market risk is a big deal because getting that extra 4 billion people vaccines is going to be really hard when you look at non-China emerging world. When you look at everywhere where it's harder to have vaccine distribution work well is going to continue to be an issue. Now, I guess you could make the case though that in most places where that's the greatest issue, it's an insignificant issue as far as the global economy. So that's a possible counter argument to what I said. But I could see it being about vaccine distribution over time. Like there's going to be COVID in areas where it's tough to get vaccine distribution.
Okay.
Does that make sense?
Yeah, no, that makes sense. I would note too that this survey was taken before a lot of the Afghan issues were creeping up. So
Right.
Geopolitical risk is actually near all-time lows here in the fund managers survey. So that's something that we'll be watching for, perhaps changing in September. But for now, these are the key concerns for a lot of the fund managers that were being surveyed by Bank of America. Moving on, in fund managers survey, investors are still tilted towards cyclicals despite paring back exposures. So overall exposure to the cyclicals had been brought in, certainly on the commodity side. However, that doesn't necessarily match up again with that infrastructure piece, Brett. And that's one of the things that I guess I was kind of looking at. Do you have any thoughts on the current exposure towards cyclicals?
That's pretty interesting to see that this is what is reported in this, given that we had seen such a rollover in that IWD IWF ratio chart, which is the Russell 1000 value cyclical side versus the Russell 1000 growth tech side, right? Like we'd seen such a rollover in that. It's interesting to see that we haven't. I mean, I guess they've pared back exposure, and I guess in a relative sense, we've seen a change. You really would need to see a time series on this chart, but it's interesting that it's not more already back toward tech and growth.
Yeah, it's certainly something that we're going to be watching closely here. There's definitely been a lot of fluctuations too. It feels like in that space, Brett. Like,
Oh man, every day.
a lot of the times I'll look at leaders and laggards on Tuesday, and then I'll come back in, and it's basically been flipped 180 on
Did you
Wednesday.
see the 1 minute correlation chart I posted between the 10-year rate and the IWD IWF ratio chart?
I did not.
It was for half a day. It was perfectly correlated. So in other words, the 10-year rate, it was moving exactly with the ratio between the Russell 1000 value and the Russell 1000 growth.
You think that's just algos kind of pinned to that?
But I do, but it's amazing. It's amazing how much capital that represents in the world. If you think about the scale of that, you're talking about 2,000 stocks or 1,000 stocks and the biggest bond market in the world.
Yeah.
Moving step for step together in a coordinated fashion on a 1 minute chart throughout a day is pretty interesting to think about what really could possibly underlie that.
Certainly highlights how closely people are pinned to that 10-year yield.
Well, yeah, or that they're both pinned to each other. This idea that moment to moment there is this, if interest rates go up, you need to sell your tech stocks and your speculative risk stocks, and you need to buy into these cyclicals. Like the idea, or that the other way around, that if the cyclicals are going to perform better, then it must mean the rates should go up. But the idea, the correlation between rates and that rotation trade is so fixed into the market's mind right now. The rotation is really the name of the game on an intraday basis. It's going to be one side of the market or the other.
Yeah. Speaking of rotation, seeing the markets bounce back and regaining some of those losses, Brett, from that headline about the Marines being involved in that tragic event out in Afghanistan. So we're back at 44.80. So we'll continue to follow the markets along. Next up, we got fund manager survey. Investors have gotten slightly more defensive in August. No real surprise there, right, Brett?
Same story.
Yeah, healthcare being the number one exposure. I know Scott's been hammering home the healthcare names, but yeah, just kind of really building on that story of defensive posturing. So people aren't leaving the markets; they're just moving into defensive areas.
Or
Right?
they were as of a week and a half to 2 weeks ago. And it looks like, in my opinion, over the last 4 days, that has changed back the other way.
Switched, yeah. Next up, global equity allocation has peaked. So would you agree with this?
I think that this entire survey and the interpretation of this survey and the way that it is presented, there seems to be I really enjoy the survey every month, and I think that the author of the way that this is presented and the analysis of it has become it has a position in terms of his interpretation, and so everything is echoing this idea that we're coming into the second half of the year where we're going to see a real sustained pullback and crunch and things, and I think analysis like this reflects that.
Yeah. All right. Then we're looking at the biggest tail risks. Really well spread out, Brett. I mean, I can't recall ever seeing something where the top 5 risks were separated by 6 percentage points total. You have 22% in inflation, 20% taper tantrum, 19% COVID-19, 17% asset bubble, 16% China policy.
It's amazing.
I mean, so basically, I don't know if would you think of this as a wall of worry? Or...
I would think so. I made this point to you last time, and I think it's a good heuristic to have when viewing this data. So if only this survey came with and of course you couldn't get people to do it probably, but let's just imagine you could, a conviction coefficient. Like how much conviction do you have in your answer? If we had a side chart next to it that just showed how much the average conviction level was, then we would know a lot more about this chart. There's a lot of answers I think that fall into this, but this is a good one. Like people are probably rank ordering these things, and they get hey, rank these. It's obviously a multiple choice test on a question like this, and you've got a bunch of fund managers controlling huge amounts of capital, ranking which one of these things is more important than the other, with probably no write-ins except for that other category, and it looks like there really wasn't much writing in. So the multiple choice questions were just random out of those top 5 to some extent, because I'm guessing conviction wasn't very high there. So, but you can see the change from the previous month, and I think that's important. So when you look at the lighter blue lines, you look at where delta was versus inflation and taper tantrum, and now they're basically all kind of pretty much the same.
Yeah, and you could argue a domino theory for each one of these too, right? Inflation pops up, so therefore that kicks off the taper tantrum, and I guess the COVID Delta variant would be an offset from inflation and taper tantrums.
That was the different outside external variable inside of it, right?
Right, and then asset bubbles. Obviously, you could easily tie that to inflation. And the China policy would probably be a one-off. Saw the U.S. debt ceiling peak up too. I think that probably pops up every time this time of the year, right?
Yeah, probably.
Although I suppose you could also argue with another $4.5 trillion of debt coming too. That could certainly be a cause for concern on that debt ceiling. But they are the tail risks, and we'll continue to monitor to see how they play out. Then the expected Fed rate hike that had been pushed out, the primary one, to 2023 at this point. You saw first half of 2023 increase, second half of 2023 increase. You also saw it pop up a little bit in the first half of 2022. Second half of 2022 remains the primary area for people, but those expectations had been pulled in a little bit, as had 2024 for that matter, but that still remains near the bottom. You got any thoughts on the readings of this for 2022 versus 2023?
No, I mean, it's dropped a little bit second half of 2022. And that matches up with everything we've been saying basically. Like maybe we showed you the dot list earlier, like the which 7 were the magnificent 7 of the 2022 dots as of a couple months ago, and maybe this is saying, hey, maybe one of those dots is tipping back the other way as of 2 weeks ago, and probably because of Delta. But it's still kind of centering around this, and this is something we've talked about, that this is what the Eurodollar futures forward curve has been showing since January as when the first hike would happen. So gradually we're seeing market expectations and Fed dots coalesce around what the market was saying in the Eurodollar futures market basically 7-8 months ago, which is somewhere between October and December of 2022, we get our first rate hike.
All right. Then we got global bond yields have fallen on peak U.S. growth and inflation again. Just kind of continues to hammer home those expectations. But I thought it was an interesting slide to just kind of show where people think that where the fall in bond yields, what was due to. 34% thought peak U.S. growth and inflation. 27% thought positioning, which I know is something you followed closely, Brett, and only 21% had COVID-19 Delta variant. So is there anything in the positioning that you've been seeing as of late?
No, I feel like probably there's a domino theory here too.
Yeah.
Like if you think that the persistence of COVID being a factor, it changes position and it changes peak U.S. growth and inflation expectations and everything. So I mean, I think that there's been some of that kind of difficult to disentangle forces at play in terms of defining where global bond yields have gone. But it's possible that, if you totally remove Delta from the equation, and let's say we had 100% vaccination rate and it's a perfect vaccine and we're done with this completely, you might also see people starting to see plenty of reason to look for some kind of shift in especially second derivative ideas about growth.
All right. Next up, what would you most like to see companies do with cash flow? Just jumping into the corporate side, just wanted to put this because return cash to shareholders continues to be on the rise, and we saw a number of companies, particularly retailers, announce that as of late. Improved balance sheets, that continues to slip there. People feel pretty comfortable
That's
with
done.
debt
Yeah.
positions. Cheap money, obviously, also adding in. And then increased capital spending, saw a little bit of a bounce back. So really, you saw the improved balance sheet falter in favor of returning cash to shareholders and an increase in capital spending. So that certainly points to a bullish expectation on the corporate side, right, Brett?
Yeah, so I always found this chart so interesting. I think, at the moment when you get to that yellow crossing above that dark blue is going to be, when we're at an end.
Yeah. That would probably be fair. It's still a long ways to go there, I suppose, right?
Yeah, right. Exactly.
Okay. Over the next 12 months, how likely do you think it is that high quality earnings will beat low quality, high dividend yields will beat low dividend yields? And what I was seeing, as you can see in this chart, there's a number of different things, but the one thing that I kept seeing was people seem to be more interested in going into value and those large cap names moving away from the small cap names, Brett. Again, I would look at that as more defensive posturing. Would you agree with that?
Yeah, I mean, well, you tell me your thoughts. I mean, I think we're headed more into your neck of the woods here.
Yeah, I mean, again, I just look at that as people preferring to be in those big names, and the ones that they see some value in. We've certainly seen like the big tech plays taking off, and what it could point to is a little bit less breadth in this bull rally over the next couple of months. Is how I look at things. Certainly, the bigger cyclicals are standing out, and I just see people feeling a little safer being in some of those large cap names, which similar to the healthcare positioning. Where people haven't gotten bearish at all, but they're certainly looking to put their money into quote unquote safer areas, is kind of how I'm reading it.
Well, a few slides ago, we had one where my interpretation was people wanted to stay overweight equities but shift to a lower risk profile. So that would seem
Right.
to echo what you just said.
Exactly. Exactly. And that's what I see playing out in this slide. And really the majority of the slides that we've put that we pointed out so far.
Right.
So Next up, we got, I figured this would be a good one to talk about, Brett, because the US dollar has been so key. We've seen the Dixie rally up to that 93.50 area. It's running into a little bit of resistance here, but net percentage of fund managers, investors saying the US dollar is overweight. That continues to decline while the dollar is rallying. Do you find that interesting, or is this just once again building off of that positioning with being a little bit more defensive in nature?
I'm not really sure how to interpret this chart, actually.
Okay.
I mean, I don't know if I'm not really sure that I could express a meaning to this.
Okay. So we'll any thoughts on the dollar in general though?
Yeah, I mean, I think that generally speaking, when you have a disparity between the United States and the rest of the world on some level that has some kind of important cyclical consequences, and we certainly do now when you look at vaccine rates and the ability to kind of have an internally powerful economy without needing as much value add from the rest of the world, you get a strong dollar. And usually that is when people are looking for a global growth slowdown while the United States can persist through it better. That's the ultimate scenario. And on the upside of the cycle, which you could argue we are right now, that would be that the United States is going to emerge faster from something and therefore have to tighten monetary policy sooner for something. That also is probably echoed in differentials of interest rates. So we see a huge differential right now in some of the most important cross-border flows in terms of where capital is going based on a differential between interest rates. So you can borrow in a low interest rate, you can invest in a higher interest rate. The United States has the highest interest rates in the OECD world right now. So that all would suggest a tailwind for the dollar.
Yeah, no, I would completely agree with that, and we're certainly seeing that play out as the dollar index rolls higher.
So, but one caveat to that: if we start to rock back away from the idea that we're starting to see things tighten up, and we've got the potential for global growth to pick back up in the fall, and people had been overly pessimistic, you really could argue actually that we're going to there was already too much of a disparity in interest rates, so we could start to see closing of some of these spreads. So I wouldn't want to say that what I said initially is I'm bullish on the dollar outright. I could see a situation where when this survey was taken, it would be a world where you could form a bullish interpretation for the dollar. But if we start to glide back into a situation where people are more optimistic on global growth, and especially outside of the United States, and a sort of catch-up period for monetary policy in countries outside of the United States, and maybe interest rates in OECD countries outside of the United States, and we see some of the spreads close a bit, then that really would actually be a dollar short thesis. So I didn't mean to be misleading there.
Okay, well, it's a story that obviously there's a lot of moving parts. Also has that big impact on inflation overall too. So, the dollar will remain one of the key areas, and obviously something that we're going to want to watch to see how it reacts, if at all, to Powell tomorrow. So,
Yeah, and everything. Yeah, right. So it's
right,
possible that all of everything that we've said today is going to change tomorrow. Some
all right.
percentage chance.
Right. So, okay, that's going to wrap it up for us, Brett. So, just kind of recapping what we've been seeing. We talked a little bit about Jackson Hole. I don't think either one of us thinks it's going to be a major event, but that certainly doesn't mean that we're going to be turning our eyes to it. The AAII recap, we continue to follow that. It certainly helps show some of the fluctuations that we've seen in the markets, but it would also suggest that we should probably be trading lower than we are, and that raises kind of the red flag there. And you can say that about a lot of the data that we were looking at, where it suggests a much more cautious market out there, but we certainly haven't seen that play out in the tape. And I think for both of us, it seems like that keeps us a little bit more in a bullish mode going into the back half of the year. We're pretty close to Q4 at this point now, with just about 4 months left in the trading year. And just watching to see how that plays out and whether or not we can finally see a little bit of a pullback. I think that there's going to be rooms for pockets to shorting indexes, but overall, I think you kind of have to continue that bullish expectations through the back half of the year. What would be your primary takeaways from our discussion that we've had today?
I would say the main thing that I would put a stamp on is there is not a sentiment-based reason to be shorting the market right now. I mean, it's the main. That's not a red flag. So whatever else your analysis is, you can take away from this show that there is not a sentiment-based red flag that should be guiding your decisions. There may be other fundamental interpretations you have, but I think that's the main question that we would set out to answer each time we do this: is market sentiment an important directional driver for a near-term future move? Because certainly sometimes that's the case. Sometimes it's not. Right now, I would say it's not.
All right, and that is going to do it for us, Brett. We're closing it up right on an hour total, so we're getting a little bit better at shortening these up, making them a little bit more manageable. But hopefully, everybody's finding this information extremely useful in their trading, and it's all theories that Brett and I are going to continue to build upon in our commentary. So please continue to follow that. So, Brett, thanks as usual for joining us here. We did tape this. We will be posting this to the page shortly, so feel free to re-listen to it, or if you get a chance over the weekend, some quiet time, this will be a good way to get yourself prepped for the upcoming couple of weeks as we head into that Q4 season, and of course the September FOMC meeting, which will loom large for the market. So, Brett, thanks for joining us, and we'll talk to you soon.
All right, take care, Gav.
Okay, take care, everybody out there. Just going to take a slight pause in the streaming here, get this set up, and get us back onto our usual streaming channel here shortly. So I will post that to the page. You might have to do a reboot, but we should be good to go moving forward. So everybody out there, we'll be back shortly.